In this lecture, we will be talking about asset management and liability management. If you remember, in the previous lecture, we started discussing bank management and we also discussed liquidity management in the last lecture. So this lecture will be focusing on asset and liability management. Again, asset is the one side of the balance sheet which includes all the loans and all the securities. So here's the bottom line of asset management is to maximize its profits. A bank must simultaneously seek the highest returns possible on loans and securities, reduce risk, and make adequate provision for liquidity by holding liquid assets. Banks try to accomplish these three goals in four basic ways. Banks first try to find borrowers who will pay high interest rates and are unlikely to default on their loans. Those are dream customers for banks because that increases their returns. Banks also purchase securities with high returns and low risk. Bank must attempt to lower risk by diversifying. They try to diversify their assets so that if particular kind of assets go default, it doesn't suffer big loss. And finally, bank must manage the liquidity of its assets so that it can meet deposit outflow and still satisfy its reserve requirements without bearing huge costs. Remember in the last lecture, we also discussed how a bank which gives out more loans typically have less reserves. So this asset management is broadly part of that liquidity management as well, because they need to keep a more or less liquid assets so that in case there's a deposit outflow, so they should be able to liquidify those assets as soon as possible. Next, we are going to discuss liability management. Now, liability management is a very interesting thing. Before 1960s, liability management was a staid affair because nobody thought about managing the liabilities. And if you remember, what's the liability of a bank? Liability of a bank are all deposits and also borrowings that banks have made. And here's the thing, more than 60% of bank funds were obtained through checkable deposits that by law could not pay any interest. That was in 1960s. In addition, there was no market for overnight loans between banks, and banks rarely borrowed from other banks to meet their reserve needs. So banking was a pretty staid and boring job in the 1960s. However, things start changing since the 1960s, and it has evolved a lot. What we have seen that now demand deposits or checkable deposits is not the main part of their liabilities. Main parts are long-term deposits. So starting 1960s, large banks began to explore ways in which the liabilities of their balance sheets could provide them with reserves and liquidity. So they started getting more innovative, if you may say so. This move led to an expansion of overnight loans market, such as the federal funds market, and the development of new financial instruments, such as negotiable CDs, was developed in 1961, which enabled money center banks to acquire funds quickly. Again, banks were trying to find ways in which they can basically restructure their liabilities. In addition, things like negotiable CDs and bank borrowings have greatly increased in importance as a source of funds in recent years, rising from 2% of bank liabilities in 1960 to 31% by mid-2014, whereas checkable deposits have decreased in importance from 61% of bank liabilities in 1960 to 11% by mid-2014. So there's a big change in the composition of liabilities of modern banks, and these are all due to changes in the rules and regulations that happened in the financial sector, especially since the 1960s. And later on, what we'll see that how this change in the composition of liability have given rise to some of the recent financial crises. Those will be the part of our future discussions.